Hi, good morning. I'm Dan Moorhead, for those of you I haven't met. Um, I have my partners Joey Krug and Paul Vratatakit here with me, and the rest of the investment team and our management staff. We do host these calls once a month, and we've been doing this for years to try and build knowledge in the community. Sometimes there's a very specific theme where we have a CEO or two from our portfolio discuss something very specific. There's definitely a huge interest in how to invest in blockchain. So this one's a more generalist call on what the opportunity is that we're seeing in blockchain. It's really to help educate. So we have the whole investment team here to answer questions. You can go ahead and use the Q&A box. Ask questions. We'll be answering them live throughout the call. If there are any of general interest, we'll save them to the end to answer them live. And then we're happy to stay on the call as long as it takes to answer every question that you all have. So feel free to ask as many questions as you want, and we'll try and get to them all. Many of you are LPs in at least one of our funds, but for those of you new to the firm, I want to give a bit of a background on the firm. The firm was actually founded in 2003 after I left Tiger Management. In 2011, I got interested in Bitcoin. And in 2013, we launched the first cryptocurrency fund in the United States and the first blockchain venture fund. Since partnered with Paul, Joey, and 40 other fantastic people, and we managed $4.5 billion in 4 different main strategies. The genesis of the fund structure is essentially we launched the first of each of these types of funds in the space. That was great, and it is very good for those investors that want very specific exposure to a very specific type of asset in the space, or have very specific liquidity needs, like either daily in our Bitcoin fund or quarterly in our hedge funds or 10-year venture. However, that's left us with 4 separate funds. The next slide has some of our overall stats. We have 4 different programs with each very different styles of liquidity. And I'll mention later that we are now doing a fund that combines all of them in one product, because that's better for people. One question I often get is, is now a good time to invest in Bitcoin? And I've gotten that question for 8 years. And my answer is always yes, that, I think blockchain assets will be, at least an order of magnitude higher in price in the coming years. So you don't want to overthink your entry point. And I do love this stat on the bottom right, the IRR of our funds. We've done 8 different funds. We've been investing for 8 years. We've closed some funds at the absolute peak of the 2013 and 17 bubbles. We've closed some funds at the lows, but the IRR is still in the triple digits, and all of our funds have greater than 40% IRR. So the punchline is, don't overthink the opportunity. And right now, actually, the market's off 25%, or Bitcoin at least is off 25%. So it's a better time than it has been in the last 4 or 5 months to invest. With that, I want to hand it to our co-CIO, Joey Krug, to talk about the opportunity in the space.
Thanks, Dan. So at a very high level, I would say the thesis of the firm is that blockchain tech and cryptocurrencies are sort of the underpinnings of a new financial system, similar to how the internet is the underpinnings of a new information system, how it transforms media, music, and a long list of other things. We think this tech is going to do the same thing, but for finance, which we think is actually a much larger market. And so going through the history of kind of protocol evolution, in the beginning, you really just had Bitcoin, which enabled global transactions where you could send money globally at very low fees, sort of 24/7 with no downtime. And it also doubled as a store of value. The key technical problem Bitcoin solved is called the double spend problem. Basically, how do you send money from point A to point B globally, without being able to counterfeit the money or spend the same money twice? It turns out that's a really hard technical problem that took decades of work to solve. Next up, Ethereum came out. And with Ethereum added this idea of programmability to Bitcoin. And in the history of computers, whenever you add more programmability to something, it tends to get a lot more interesting. And so if you look at Ethereum, it came up with this idea of smart contracts or computer programs that basically allow you to add sort of if then else statements surrounding, sending money around. And if you think about finance, as complicated as the financial system is, really, if you boil it down to like the simplest primitive, what finance is various terms and conditions that are attached to sending money from one person to another. It's something like a swap or a derivative, an option. These are basically all things that you can summarize with if then else statements in fairly simple computer code. And so Ethereum enables anybody to do that on a sort of global system that has a lot of the same benefits of Bitcoin. And then kind of the next wave of things that's happening sort of now is things like Polkadot and also layer 2s on top of Ethereum. And so what these are doing is basically enabling more scale. So Bitcoin and Ethereum, Bitcoin does 7 to 10 transactions per second. ETH does about 15 to 20. Layer 2s and things like Polkadot do hundreds or even thousands of transactions per second, which is what you need for this tech to scale. And so if you look at this concept of decentralized finance, we think there's really 5 kind of basic primitives to any financial system. You need a unit of account to denominate trades in. For most of global trade today, that's typically the dollar. And it's no different in DeFi. A lot of DeFi transactions are denominated in USDC or DAI, which are both currencies that are pegged to the US dollar. Then you have exchanges to allow you to trade assets with no intermediary. Things like Uniswap and SushiSwap and 0x basically let you swap one cryptocurrency for another at fairly low fees and often at lower slippage or lower kind of market impacts in a site like Coinbase even these days. Next up, you have lending and issuance. This is basically debt. Protocols like Maker, Compound, and Aave are basically credit facilities. They let you borrow and lend various cryptocurrencies. And even ones like Maker are starting to kind of, get into the world of real world assets. So someday you might actually have a mortgage that you actually took out via a system like Maker. That's where this stuff is going over the next 5 to 10 years. The last 2 components are margin and leverage. And people tend to have a negative connotation with these 2 components, but I think the simplest example that I always like to use is imagine you're a business that's trying to hedge, dollar yen currency risk. If you have to put up, 100% collateral, that's going to be very, very cost inefficient because dollar yen doesn't move that much. And so margin and leverage enable you to basically hedge that risk without putting up, a full dollar for every dollar of risk you want to take. And so if you look at the DeFi ecosystem today, I'd say it really starts at the base with layer 1 blockchains, things like Polkadot, Ethereum, Bitcoin, Near, Cosmos. These are the things that everyone's building protocols on top of. If you go 1 layer up, you have oracles that basically get real world data into the blockchain, things like API3, Chainlink, and Augur. If you go 1 layer above that, you have kind of some of the protocols that people know and use today. Some of the lending ones I mentioned, decentralized exchanges, various marketplaces like Filecoin is a market for storage. So if you're looking to store a lot of data very cheaply, in the long run, you might go to Filecoin as opposed to AWS if you don't need to access the data kind of at a very high frequency. And then you have things like payments, things like Terra, which is used by a pretty sizable percentage of the Korean population for payments. Synthetic assets, which I think are really interesting. These are assets that are pegged to real world assets. So on Mir, for instance, which is a protocol that we're invested in, you can buy exposure to, Apple or Tesla stock, and it trades 24/7, with kind of no downtime. So if you want to trade Tesla or Apple after hours, you totally can on a system like Mir. And then kind of at the very top of the stack, you have what are called aggregators. These are interfaces that use a lot of the other protocols and kind of provide a simpler interface for you to interface with them without needing to kind of go directly to, say, Uniswap or 0x. 1inch is a good example of this because they're DEX aggregators. So they route your order through, up to, in theory, up to 40 decentralized exchanges to basically get you the best price for whatever you're trying to buy or sell. If you look at lending, that's been one of the most popular use cases of the past year. A year ago, there was, probably under $1 billion locked up in lending protocols, or around a billion, actually, I would say. Now it's about 43 billion. When you borrow, you can basically do one of two things. You can borrow US dollars effectively, and then go buy something else, or buy more crypto to basically use leverage. Or you can borrow another cryptocurrency and sell it and go short. Those are the sort of two things you can do with crypto lending markets. And the benefit of these, again, is that they're pretty low fee, and you can borrow and pay back whenever you want. In the past, we've actually looked at sometimes shorting cryptocurrencies, and from some players, you actually have to pay back the loan, at the close of business in New York time, as an example. But with crypto lending protocols, you don't really have that problem. Then you have decentralized exchanges. These basically are kind of the exchanges I mentioned earlier. They let you swap tokens in a peer-to-peer fashion. Even I didn't think these would grow as fast as they have. A year ago, there was a very kind of tiny amount of money locked up in DEXs, again, under $1 billion. Now there's about 26 billion. I'd say there's roughly 10 decentralized exchanges that actually see, kind of sizable, meaningful volumes, and there's maybe 30 or so kind of long tail ones that don't see as much traction. But it's not uncommon that in some days you might see something like Uniswap do 30 or 40% of the volume of a centralized exchange like Coinbase. And so the tech is sort of developing, even faster than we had sort of thought. I thought that might be something that took 5 years, but really we're only a few years in, and that's already happening. Stablecoins are a really interesting market. One thing people always talk about is this concept of central bank digital currencies, and you have a digital version of the dollar. Kind of the interesting, cool thing is that they're already here. They're just not central bank backed. So there already are digital versions of the dollar, things like Tether, USDC, DAI, and a kind of long list of others. They're currently around $72 billion in market cap. I think the total amount of dollars in circulation is something like 2 trillion. So it's actually a pretty substantial number that's already become digitized in really only a couple of 2 or 3 years. And so I think this is a trend that's going to continue to happen because, again, the benefits of just being able to send dollars with no wire fee, globally, again, 24/7 with no bank holidays is a huge benefit. There's no cutoff time to send it like your bank. You might have to send a wire before 2:30 p.m. or whatever. That's just not a thing in this world. It's much more efficient. And so I don't know why long term, I think digital versions of the dollar, I think are going to kind of eat away at banks and wire transfers over a long-term time horizon. And then last is DeFi growth. And so if you look at these metrics, you can kind of see the scale of the growth that's been happening here, both in terms of value locked in decentralized exchange protocols and decentralized exchange trading volumes. So the first one is DeFi protocols, again, under $1 billion. Now it's over 75 billion. And then DEX volumes. And this DEX volume chart actually only includes the decentralized exchanges on Ethereum. If you include ones on other chains, it's actually been growing much more rapidly than this chart would even suggest. But again, in May of 2020, there was about $1 billion in volume. This month, it's kind of over an $80 billion run rate for volume on Ethereum-based decentralized exchanges alone. And so the punchline here is that DeFi growth is real. It's happening very, very rapidly. And we think this is kind of the next big sector that crypto is going to impact. Bitcoin, you had digital gold. With DeFi, you're going to have digital finance. And with that, I'll turn it back to Dan to talk about the macro standpoint.
Thanks, Joey. Yeah, so the way I like to think about it is we've been evangelizing this new asset class for 8 years, and the technology has been built out, like Joey has been talking about, some other exciting opportunities that Paul will talk about. But why now? What's different? It really is two huge things happening at the same time. The first is the monetary stimulus. We're seeing literally off the charts amount of money being created. And these graphs are both the increase in the supply of paper money, and then on the left, the price of new cryptocurrencies. And they're basically the same thing, that as we're printing more and more paper money, the value of other things is going up. And in June, the United States started printing more money each month than it did in the first 200 years of its existence. The United States is going to have a $5 trillion deficit in fiscal 2020 and fiscal 2021. That is compared to 9 trillion in the first 231 years of the country's existence. So in our March of 2020 investor letter, we said that Bitcoin was created in a financial crisis and it would come of age in this financial crisis. And it really is. The price of Bitcoin and other cryptocurrencies are way up. But the price of all other things that are not quantitatively easable are way up too. So a different perspective might be that all those things are actually relatively constant. And what is changing is the price of paper money. And then on the next screen, we have the value of paper money priced in things whose quantity can't be eased. Bitcoin is on there, gold's on there, but also things like grams of sugar, board feet of lumber, the S&P 500. So really what is happening is most everything else is relatively constant, and the trillions and trillions of paper money that's being printed is devaluing. And to keep it all in perspective, $1 trillion is $5,000 per adult in the United States. It's a lot of money. And to be doing 5 of those, that's $25,000 per adult, $50,000 per family. So it really is just a staggering amount. That has prompted legendary investors to get involved in the space. You have investors like Paul Jones and Stan Druckenmiller, both coming in literally saying they're buying it because it reminds them of gold. And on the previous graph, the least good performer was actually gold, which might be counterintuitive to many people. If you would have told them 18 months ago that the US government would start printing $5 trillion in paper money, they would say that gold would be a great hedge for that. Over the last 5,000 years, gold's been a great hedge, but I think it's now being disrupted by Bitcoin and other blockchains. That's brought in a host of other legendary investors, including a super high profile lightning rod called Elon Musk. And there's a couple questions already about Dogecoin. So at the end, we'll wrap up talking about those. That's then brought in massive corporations, which is a really new thing. You know, when we started evangelizing for Bitcoin, there was not even a chance any public company would touch it. Square actually was one of the first 3 years ago. They got engaged. But now you have a bunch of public companies putting it on their balance sheet, and that's helping to credentialize the space. Same thing with thought-leading investors like endowments have gotten into crypto directly, some through venture, some through the tokens, and many through a mix of both. That's allowing mainstream adoption to happen. In October, I think last year, PayPal turned on 300 million people to the ability to buy crypto. That was a big advancement because even a few years ago, it was very cumbersome to get money into cryptocurrencies. You had to take a selfie of yourself with your passport and send it to an exchange and wait for a week. Now there are hundreds of millions of people that can essentially one click into crypto. Big firms like Morgan Stanley and even JP Morgan have gotten engaged in crypto. So it really is helping people get access to it. Essentially, the last thing left is regulatory clarity from the SEC in the United States. Most of the regulatory bodies in the US ruled on crypto a long time ago, 8 years ago in many cases, and have ruled in each case in the best possible way they could rule. The SEC is still out there. I have some empathy for them. They're trying to decide whether these really complicated and interesting digital ledger technologies are similar to or dissimilar to an orange grove that Mr. Howey developed in Florida in the 1940s, which I wouldn't want to be in charge of that decision, but that's the only thing left. So on to the markets. We are a financial investor, you know, so we're thinking about the markets. And I've been trading price cycles for 35 years, and this is by far the most compelling trade I've ever seen because it's so asymmetric. And when I was at Tiger Management, we were always looking for trades where the upside was much bigger than the downside. And there was interesting ones coming along every 3 or 4 years. But this is just orders of magnitude bigger than any of those trades. Investing in cryptocurrency is disrupting dozens of different markets, all of which are the largest markets on earth. Digital payments, gold, money, all of these things are being disrupted. And so you certainly have much more upside than you do downside. And there is a question that we're going to answer live is, do we have as much downside as we used to have? Bitcoin's gone through a handful of crazy up moves and crazy down moves. So on the next slide, we do have those graphed, but we graph them logarithmically. And when you graph any very disruptive technology like Apple or Amazon or Bitcoin, in the normal format, you get a hockey stick and it doesn't really show any information. But if you graph it on a log basis, you get the consistent compound annual growth. And you can see Bitcoin's actually been relatively consistent for 10 years. It has a 10-year compound annual growth rate of 233%. That means it's more than tripled on average every year for 10 years. It's been doing it for a long time. I think it'll keep doing it for a while. The other reason to hold it in your portfolio is it has zero correlation to other major asset classes. And that is the dream asset to have in one's portfolio, an asset that has enormous upside and has zero correlation to everything else. So there's one little caveat in the times of incredible market stress. It has very short-term correlation to the S&P 500 and other risk assets. So in March of last year, when everyone was reacting to the impact of the virus, it did have very short-term correlation. Our analysis in our March investor letter last year was that it, on average, it was 71 days of higher correlation, and then it goes back to zero. And that's basically what's happened. So how does one value cryptocurrency? It's some new protocols have cash flows, and you can actually do price earnings multiples on them. But most of them, like Bitcoin, are essentially utility tokens. Their only value is how useful they are and whether people find them useful. The amount of people using Bitcoin has been increasing at a geometric rate. The number of people using Bitcoin has gone up 10x every 2 years for the last 10 years. The price of Bitcoin has also gone up exactly 10x, exactly every 2 years. This is a head-spinning graphic that you have two data series go up 5 orders of magnitude and retain exactly the same ratio to each other. In simplest terms, means that for every 1 million people that come into the Bitcoin ecosystem, the price rises $200. That is intuitively kind of, makes sense. And if one were to extrapolate that out, where could the terminal price of Bitcoin be? Well, there are 3.5 billion people who have the only requirement for using Bitcoin, a smartphone, and that would put the price at $700,000. I actually think that's possible. And there is a little bit of an arms race in the pundit space to keep throwing out crazier and crazier prices, 1 million, 2 million, whatever for Bitcoin. This one actually makes a lot of sense to me. And the way to visualize the supply and demand is old school Econ 101 graphic, that if you have supply and demand curves and there are shocks to them, like PayPal turning on is a very big shock, bringing 300 million people into the ecosystem that shifts the demand curve up. There have been shocks like that. Now we have Morgan Stanley as a new shock. Now we have JP Morgan shifting the price up. And then it's important to note that the supply curve also shifts. Every 4 years, the number of Bitcoin that are issued is cut in half, and that happened in May of last year. And we made a prediction on the price of Bitcoin based on the halving, which has held very well over the last year and a bit. The last thing I'd like to say about the price of Bitcoin itself is a great and common negative would be, oh, it's too volatile. I can't have it in my portfolio. Yeah, it's volatile. It has a 70% annualized volatility. That's a high number. To put it in context, it's only a little bit higher than Amazon, which is an equally disruptive and roughly same value asset out there. So Amazon and Bitcoin have roughly the same amount of volatility. I actually did notice that Amazon reported earnings that were up 230%, which is also exactly what Bitcoin's compound annual growth rate is. But the punchline is, even with that volatility and There have been 4 bear markets in the last 10 years of Bitcoin, which have averaged 83% drawdown. It still has only hit one new low for a calendar year. So that is just an amazing fact that although the volatility is there and there's no excusing it, almost all the volatility is on the upside, which is absolutely fantastic. And one way to think about that is in our college economic courses and throughout our careers with modern portfolio theory, we've been taught that volatility is bad. You're always trying to minimize volatility. The perspective I would have is Bitcoin is essentially a call option on the future payment rail of the world. And so when you're long a call option, vol is good. And now with the printing of incredible amounts of paper money, one could say that cryptocurrency is also a put option on paper money. And with incredible volatility, that's also good. So here we use Bitcoin as a proxy for the whole industry because it's been around the longest. It's the word everybody knows. Sometimes people even use it kind of the way people use Kleenex to mean facial tissues when they're really talking about all blockchains out there. So it's important to note that as a firm, we're very bullish on Bitcoin, definitely, but we're much more bullish on Ethereum than Bitcoin and even Polkadot and tokens built on top of Ethereum and Polkadot, particularly in the DeFi space, that we're even more bullish. And we've had that stance for 8 months and been very public on our letters on it. It's now starting to happen. The next graphic has the ratio of Ethereum's market share to Bitcoin's. It had spent most of the last couple of years at around 20%. It's now doubled. It's actually almost touching 50% today. And so we are very bullish on crypto generally. Bitcoin, yes, but there are a handful of questions on how much Bitcoin should be in a portfolio. We'll take those a bit later, but we would say we think we should weight things like Ethereum and Polkadot higher. And with that, I want to hand it to Paul Baratataka to talk about our funds.
Thanks, Dan. So I'm going to talk about our funds. Specifically, we really provide a full spectrum of exposure to the space, ranging from illiquid venture capital assets, and that also includes, illiquid or a little bit more illiquid early stage token, and then also more liquid assets such as Bitcoin and other cryptocurrencies that are already on other exchanges. So why don't we go to the next slide? So the Pantera hedge funds are the funds that are open right now, and they accept subscriptions on a monthly basis. And none of our hedge funds have lockups, and they are now all of them open to non-US investors. We can start with the early stage token fund that is quarterly liquidity. And the strategy there is to invest into early stage token projects before they actually launch their token. And the investment style would be finding projects as they are, writing a white paper, building some technology, building a product, and helping them all the way until their token listing, which means everything from team building to building their product, technology, regulatory, community, etc. And we are entering in at a valuation that we think is going to be at a significant discount to when they actually launch their token. So think of it almost like a pre-IPO fund for a public offering. And these days we're getting in at the first or second round, maybe valuations between $10 to $100 million token network valuation. And an example of a project going out to the public, they could go out on a centralized or decentralized exchange and start off anywhere between 300 to 400 million to $1 billion token network valuation. So for us, we're providing a lot of brand and a lot of help to get these token projects to that point. And then eventually we will get out of those positions at a later date and back into early stage token projects. So that's the early stage token fund. The liquid token fund is investing into tokens that are a bit more later stage or already on the secondary markets and exchanges. These have sufficient liquidity and are on exchanges that we feel are legitimate and most of the strategy is discretionary. So a bit of both, investing into tokens that we feel like fit our thesis in the short and medium term, in addition to looking at a bunch of data. As Dan mentioned, there's cash flow data to value these investments and to actually compare them within certain categories, whether it's lending protocols, whether it's stable coins, payment protocols, et cetera, and figure out how to size these positions based off of conviction and based off of value. And so most of our investments are discretionary, but part of the fund is also quantitative, algorithmic, based off of data around sentiment, momentum, et cetera. And then that is also quarterly liquidity and now open to international investors. And the last fund that we have is our Pantera Bitcoin Fund. You can probably wonder, why would I buy Bitcoin through Pantera versus Coinbase or somewhere else? Number one, it's better pricing. Number two, it's the convenience and not having to worry about passwords and the management of that asset and the sort of trading in and out of that asset. And I think the last thing would be the customer service. We have an investor relations team that is really catered toward providing answers to all of your questions and all of your sort of auditing and tax needs. And so think of it as a white glove service or a Bitcoin ETF that actually exists. So I won't talk too much about this slide, but you can read the numbers here. All of our funds have performed very, very well. Early stage token fund, I'd probably say is the highest reward, but potentially the highest risk of all of those funds. But when you get in early, the returns can be tremendous. On the liquid token fund, I think the interesting strategy around that compared to potentially building a basket of tokens yourselves is while we can buy these tokens off exchanges, we actually do negotiate some OTC deals with token projects so that, especially for ones that we are a bit longer term on, we can get significant discounts anywhere from 20 to 70% discount to the spot price, and therefore really just kind of de-risk our investment and provide greater returns for investors. And on the liquid token side, I think an interesting data point to look at is, Bitcoin is up about 40, 50% this year, but both of our hedge funds, the early stage token fund and the liquid token fund, is up 400% this year. So active management really does deliver better returns even on the liquid side. And then the Pantera Bitcoin Fund continues to do well, best performing hedge fund of all time. Really excited about the inflows that are coming in from institutional investors into that fund. So the last slide I'll talk about are some case studies on the early stage token side of things. I'll actually start with Polkadot. It's a great case study. In 2017, we're starting to see a lot of projects issuing tokens and doing ICOs and crowdfunding. But one of the problems that people were foreseeing was that Ethereum would have difficulty scaling. And the CTO of Ethereum, Gavin Wood, whom we've known for a long time because he was building projects and tools on top of Ethereum, a company called Parity, thought about launching a new blockchain infrastructure that would provide scalability and interoperability compared to Ethereum. And it's called Polkadot. And we were one of the first investors to get in touch with Gavin and wanting to invest in his project, knowing that we had a very strong brand and a great way to help build the ecosystem. We were one of the largest checks into Polkadot at the time. And this investment has done very well so far. So currently the multiple is at 132 times capital. And we have provided quite a bit of value for Polkadot, where we've really helped them sort of build up this ecosystem, invest in projects building on top of Polkadot, and have been really just helpful in terms of providing governance, providing liquidity to projects. And we think that Polkadot is a very strong contender. I think they have the second largest developer ecosystem of all of the blockchains out there right now, and right behind Ethereum in terms of developer adoption. So we think that one has promise, and right now is even a bit undervalued. And so we're big holders of Polkadot right now in the early stage token fund. And the other project that I'll talk about is Dodo. So one of the one of the things that we have an advantage over maybe some of the traditional VCs is not only are we investing domestically, but we're investing internationally. And how can we do that? We have very strong partners all around the world, whether it's in China, Southeast Asia, Europe, Latin America, and these partners really help bring us onto these deals as leads or co-leads. And Dodo is basically starting off as the Uniswap or the DeFi project in China that's gotten the most interest. Very, very strong team, strong DeFi backgrounds, having started a decentralized exchange in 2017. And what they have launched so far is a decentralized exchange, but instead of using automated market maker, they use a proactive market maker, which improves upon the algorithm on AMMs like Uniswap. In addition to that, they're really expanding over to aggregation, to NFTs, things like that. And so building a full stack solution for DeFi in China and Asia, and hopefully expanding globally. We invested and led the Series A. It's been an 85x multiple so far, and we've been really helpful for them in terms of just partnerships and bringing projects on board to actually launch their sort of token offerings, and kind of bringing the sort of Western branding and partnerships over to sort of a more Asian style project.
Thanks, Paul. So I want to wrap up talking about the newest products we are offering to help people get invested to the blockchain opportunity. It's on the next slide, we have a better visual for it. As I mentioned, since we launched the first of each of these other types of funds, it ended up with 4 silos. Each new asset we buy can only go in one fund. And again, that's awesome for many investors. About 30% of our investors already have exposure to more than one Panthera fund. Some have jumped the gun and done a DIY version of our blockchain fund, but that's basically what the blockchain fund is. It's a fund that spans the entire spectrum of all the assets. It's great for people that want to make an allocation in their portfolio to the concept of blockchain, but they don't want to, stress about whether it should be venture or early stage tokens or liquid things like, Bitcoin or Ethereum. So the details of the fund are on the next page. We're targeting 600 million, which is a 15% of our current AUM. So it should be investable and doable. Unfortunately, we are limiting it to $1 million minimums, which is very different than our historical stance of trying to be as accommodating and inclusive as possible. All of our other funds have a $100,000 minimum. But this fund is investing for 10 years, and we have limited capacity to invest in a lot of these venture and early stage token deals. The fund will be roughly 40% venture equity when it's fully invested over the next 2 or 3 years. And then, 20 or 30% early stage tokens, and the balance in liquid tokens. And I did want to take that opportunity to talk about liquid tokens, and there's been a bunch of questions from LPs about how are the markets performing. Obviously, Bitcoin is down a lot, and we'll talk about some of the reasons in 1 second. But are liquid token funds up on the year or on the month, and way up on the year? So this is a great time to talk about the value of active management. There was a time that just owning Bitcoin was fine. That's how I started, and 100% of my exposure in the space was just Bitcoin. And then for quite a long time, we actually used to use an internal kind of poor man's index, 60% Bitcoin, 40% ETH, and that was kind of enough, right? But there are so many, really important projects that are not Bitcoin or ETH. So you can create a lot of value by investing in and actively trading the ones that aren't. In January, the percentage of the market that was just Bitcoin plus Ethereum got to 84%. So the other 5,000 tokens were only worth 16%. That has gone up to 41% now. So that's really the story, is that Bitcoin has been kind of stable to drifting down lately, and Ethereum and other things have gone way up. So as an example of the alpha that can be created, this month, Bitcoin is down 21%, but our liquid tokens fund is up 3%. And it's been doing that essentially all year. The liquid token, Bitcoin now is up 54% year to date, and the liquid token fund is up 435%. We think that will persist. And the reason I'm mentioning it now with the blockchain fund is when we say we're going to invest a third or so of the capital in liquid tokens, that doesn't mean we're just going to get long Bitcoin and ETH. It means we're going to get invested in much more interesting tokens, and we're going to change those allocations over the quarters and years that someone would be invested in the fund. Okay, so to take some of the questions we meant to answer live, and Joey and I and Paul will trade off answering, some of these questions. So there was a couple of questions on the quote correct weighting for Bitcoin in a portfolio. Obviously that's a personal opinion for each person to have. I would say it's actually rather low right now. That in January, I guess it was, when Bitcoin hit 70% of the overall market cap, some people in the industry call it Bitcoin dominance, hit 70, we sold all the Bitcoin in our 2 hedge funds and went much longer Ethereum, Polkadot, 1inch, a bunch of DeFi protocols. I think we're getting there. Bitcoin's now 40% of the overall market. Ethereum is worth 48% of the market cap of Bitcoin. So we're getting close. And, but I would say currently, I would have the weighting of Bitcoin rather low in a portfolio, and I would be overweight the other things. So in our funds, we are underweight Bitcoin. We're much lower than a 40% weight. And in our hedge funds, it's close to 0 right now. The question of why be patient is one of the questions that a ton of people asked about Elon Musk, Bitcoin, Dogecoin, and all of his tweets. I actually don't spend a ton of time following what he's doing, but he is obviously an enormous lightning rod for publicity. I did catch his Saturday Night Live appearance, which was 4, 5, 6 minutes talking about cryptocurrency. But 2 days later, he decided that he had some ESG concerns about Bitcoin brand blockchain, and that Tesla would no longer accept Bitcoin for cars. The important point to make is I can't imagine they really sold that many cars using Bitcoin, and certainly nowhere near the $1.5 billion that the company invested off its treasury balance sheet into Bitcoin. Tesla still holds that Bitcoin on their balance sheet. So, that honestly, I can't even really comment past that. The thing about his comments on Dogecoin, and just kind of Dogecoin in general, is a lot of people that have a lot of energy about it. I don't own any Dogecoin, so I'm not long it, nor do I really care much about it. The only thing I would say is I'm actually totally neutral on it. There's a lot of people in the space that there's some wild bulls on it, obviously, and then there's a lot of people that are completely crazed, hating it. I'm neutral on it. It's just a fork of Litecoin. There's a lot of altcoins out there that are copies of Bitcoin, and Litecoin is basically just a copy of Bitcoin. So it's just another version of these things. And maybe it started as a joke, but so did Marcel Duchamp put a urinal on a wall in Paris art show 100 years ago. Now it's worth $150 million. So I can't judge that. And it's very important to point out that Tesla has never remotely bought Dogecoin. They only buy Bitcoin. So I'm kind of neutral on Doge, and that's no biggie. A couple other questions on the bull run and how long it'll last, and will the crash be as hard as the previous crashes? Bitcoin, as I mentioned, has had a handful of really big cycles. Up thousands of percent, down 83% on average. I strongly believe that as it grows and the base of ownership broadens, and it's further away from kind of the early scary things like maybe Bitcoin would get hacked or maybe governments are outlawed or whatever, I think those cycles have to moderate. I mean, I just think it's very, very likely that both the upside and the downside is going to be attenuated, and we're already seeing that in the first halving, the price of Bitcoin went up 9,000%. In the second halving, it went up 3,000%. And then we forecast it would go up 1,000% this time. So even the bull case are attenuating. And I also think the bear case, for a long time, I used to tell people, you could lose everything. It could all go to zero. And now, I just don't think that. I think the next bear market might be like a 50 or 60% retracement, which in the normal securities world sounds super crazy, but relative to some 80 and 90+% bear markets in crypto, it's not that bad. And then how long is it going to go question? It just feels like with all these massive firms like JP Morgan, Morgan Stanley turning on, it just feels like it's probably going to go, for another 6, 9, 12 months. So our view is, we're still in the middle of the cycle. In our last investor letter, we published a graphic that shows Bitcoin's price deviation relative to its 10-year log trend. And at the time, it was spot on its log trend. So we said it's kind of fair value. It's not, overly priced or undervalued. It's now 25% below its 10-year regression. So, I'd say this is a better time than most to be, getting engaged in the markets. And with that, I want to hand it to Joey or Paul to answer a few questions, and I'll come back and answer some more.
There's a few kind of general questions about risk in DeFi. Somebody asked, like, where is risk concentrated in DeFi? I think probably one of the bigger risks in DeFi has to do with liquidations. So, like, if you're, borrowing and lending and you have a very levered position, or you're using like a perpetuals or futures contract and you again have a very levered position, block times are often only, every 15 to 30 seconds. And so you'll run into an issue where the price of ETH may drop a lot in that time window, and you kind of have cascading liquidations. That's one of the risks in DeFi, I think, that you can see. Outside of that, I think the other risk is just smart contract risk. It's really tough to write secure smart contracts. Another question is about performance in May. So somebody asked, what are early stage token fund and liquid token fund, how are they doing in the drawdown that we're seeing in May right now? And so as of this morning, early stage was down about 1.5%, and liquid token fund was up about 3.2%. If you compare to Bitcoin, Bitcoin's down about 20.7% month to date. And so I think the reason for that is DeFi has really outperformed in this drawdown, which is kind of an interesting phenomenon and might be like surprising because they're smaller cap assets. But DeFi had also gone through like a 3-month kind of range bound consolidation period. And just before this downswing, it actually kind of flipped bullish, even versus Ethereum, and certainly versus Bitcoin. And so that trend doesn't seem to have been impacted by the kind of broader downturn. In fact, DeFi versus ETH and DeFi versus Bitcoin is actually outperforming more and more, even as the drawdown has kind of deepened a bit, which is good to see because that's a lot of what our AUM is in. Last 2 questions I'll answer before maybe handing it over to Paul or Dan again is on decentralized apps. Are we seeing things outside of DeFi, or is that still too nascent? I think it's mainly DeFi today. There are some NFT applications which are kind of early and kind of potentially promising, but I'll say a lot of the traction is in DeFi. And then the other question is, how has our valuation framework for liquid tokens changed over the years? We actually just sent out a 10-page LP letter kind of going over this and a bunch of other stuff on strategy on the fund. So if you're interested in that, we can definitely send it out to you and kind of go through that. But I'd say at a very high level, the biggest difference between now and 2017 is now there's real metrics. You couldn't put a multiple on something because it had 0 revenue in 2017. Now you can compare a lot of these DeFi assets on like earnings or revenue and a lot of kind of traditional metrics. You can look at growth rates. And so there's a lot of stuff that you can do from like a fundamental analysis standpoint that we do now that in 2017 just wasn't possible.
Thanks. So there's a great question on the how do we evaluate the risk of institutional adoption of Bitcoin being slowed to the recent ESG noise? That's a great question. It's literally the subject of what would be our June investor letter, is we were going to talk about this thing. Admittedly, Elon Musk blew it up into a much, much bigger thing. And so the very high level thoughts I would share are, we just talked about how Bitcoin's only 40% of the blockchain ecosystem. A hugely important thing is the other 60% are mainly proof of stake or other non-power consuming consensus mechanisms. So only a minority of the blockchain ecosystem today, and potentially a small minority 10 years from now, are energy consuming blockchains. The Bitcoin one, I have to admit that the energy consumption is the Achilles heel of Bitcoin. And there are some people that just kind of hand wave it away, like, oh, it's all renewables, which I don't think is probably true. And I don't actually have the data, and I don't know if anyone really has the exact data, but you have to, and there are huge examples of trapped energy, like Iceland geothermal, or, gas flares in really remote regions that there's no way to actually pipe the natural gas to, any kind of consumer, where yes, it is completely wasted or renewable energy being used for Bitcoin transaction processing, called mining. But you got to think some Chinese coal is going into Bitcoin. So like, I think that is a real issue. The bit I think that is being underlooked is the S and the G part of ESG. And Bitcoin and all the other blockchains are going to have such an amazingly positive impact on 3 billion people that I really think when it's all said and done, it's going to look pretty good on an ESG score. And, like, for example, I don't even debate ESG with anyone who's ever owned gold. Gold is like the perfect trifecta of horrible ESG-ness. It's just open pit strip mines with all kinds of toxic chemicals leaching out of some of the world's worst run countries on earth. So, nothing, we're not in utopia, nothing's perfect. And so, my view is it's probably being overblown at present, and it's too much focus on Bitcoin and not on the rest of the market and all that. But I will very much admit Elon Musk is a very powerful marketer, and so it's something we need to be conscious of. And so the answer to the participants' question is yes. I think it will slow down institutional adoption because people are it's definitely a topic that's now in people's consciousness, and there is a real issue with the Bitcoin brand blockchain definitely using some sources of bad energy. Another question was, despite the recent price drawdown of BTC, do we stick with our August forecast that we made in April of last year, that it would hit 115,000 in August 2021? Yes, it's definitely, I'm very strongly believing that Bitcoin is going to more than double over the next, say 4, 5, 6 months. And although it hit its last price target literally on the day we predicted, I'm a little fuzzier on the overall outcome. But the punchline is, I think it's incredibly likely that Bitcoin still goes way up and does it in this calendar year. And then there's another question, important one, that's on a lot of people's minds, are our general view on China being at the forefront of digital currencies, and will it be a replacement for physical cash? The answer is yes on both of those. China is way ahead of other governments on digital currency, and it will be a replacement for digital cash. So on the Chinese part first is, China's about 6 years ahead of the Federal Reserve in the United States on building a central bank digital currency. They've been investing in it for a long time, very seriously. They announced it almost 2 years ago now, not coincidentally 2 days after Facebook announced their version of a stable coin. China announced theirs. The former chairman of the CFTC, Chris Giancarlo, wrote a fantastic op-ed in the Wall Street Journal then, naming it America's Sputnik moment in finance, which for you younger viewers out there was when the Soviets launched a spaceship and the West realized they were way behind. That is what is happening here. China is way out ahead of the West in building a blockchain-based payment system. It has massive geopolitical issues. The United States has exerted enormous amount of influence over the world with its sanctions regime, because basically everybody on earth has to use a bank that does business in New York City. And so, you know, countries like Venezuela or Iran, you know, enormous pressure can be put on them by the United States and its allies. If another country like China built a payment system that's outside of that sanctions regime, it will, you know, it will lessen the power of those regimes. So it is very, very important. It's good to see other central banks now getting, you know, trying to get engaged and catch up. And the question on, you know, whether it will be a replacement for cash is a fun one. A few years ago, a friend of mine that's on the board of SEB, one of the biggest banks in Scandinavia, invited me to Stockholm to speak to all their major companies and investors on the future of money. And so, you know, I've been traveling to Sweden for a long time for macro investments. So I grabbed my little envelope of Swedish kroner and, you know, bombed over. And in the morning when I got there, I wanted to go get a pastry, and I handed a 20 kroner note to the cashier, and she was like, wow, I haven't seen one of these in years. So I was the Silicon Valley VC coming to talk about the future of money, and I was using paper money, and Sweden had already gotten rid of paper money. So yeah, pretty soon China will go to completely, you know, virtual payment systems, and the rest of the world will stop using pieces of paper and metal in our pants as money, and we'll go to either a central bank version of a digital currency or like a private version, you know, like Bitcoin or Ethereum. But it's, you know, is definitely happening. And with that, I'll hand it back to Joey to answer a couple of questions.
Awesome. Yeah, there's a question from Michael about hedging or things like that in the early stage token fund, or do we just sell tokens so we see the right signals? So I'd say in that fund, you know, we don't really do too much hedging. It would be more that we would sell stuff if we think that the market is overheated or overvalued. And so back in February, we actually sold a good chunk of Ether and a little bit of DOT, and then we rebought them back. I think it was about 7 to 10 days later, basically right at the market bottom for that, you know, swing. Recently, in the kind of recent, you know, sell-off in May, we haven't sold things, mostly because, for one, the DeFi sector, which is a lot of that fund, hasn't really been impacted as much. You know, DeFi is basically flat versus a week ago, versus, you know, Bitcoin and Ether down 25%. And so, and then the other thing too is the sell-off recently was mostly triggered by Elon tweeting, plus some other like kind of fake news tweets from a few Twitter accounts that people panicked over in China. And so I think it's not something that's kind of a sell-off that's much harder to predict, because there's not really any fundamental or real technical basis for it. There's a question on, you know, how much of our portfolio is in the top 5 coins by market cap historically, and how much of the returns are generated by that. And I'd say pretty little. You know, very little in the early stage token fund, and also very little in the liquid token fund. The asset that we own the most of in the top 5 is really Ethereum, and that's, you know, it depends on the day, but it's sub 20% in early stage, and it's about 25% right now. We're kind of overweight in a liquid token fund on ETH, but other than that, you know, we're mostly in the smaller assets that we think have much more room to run.
Joey, I'll answer one that we've gotten occasionally. Is somebody asked, you know, can you give us a sense as to the return projections for the new blockchain fund, or, you know, will it be similar to other funds, or will it be more conservative in nature, less volatile? So, and the way to think about it is, it's to some extent, it is like a blend of our 4 existing funds. We're going to come into work every day and do the same thing we've been doing for 8 years. So it's not like there's any new assets or new strategies or new types of risk in the fund. So the easiest way to think about it will be the return stream should be less volatile than each separate fund because it's a blend of 4 things. And sometimes diversification is going to help us that one fund will be up while the other fund will be down, or the one type of asset will be up when the other type will be down. And then the returns themselves will probably be, very similar to a blend of our existing funds. Historically, tokens have provided higher IRRs than venture investing. Venture investing has been in the 40s to 60% IRRs, and tokens have been 100. Those two might converge over time. If they don't, then that might be informative. So I would say that the returns would be somewhere in, think of it as a blend of the 4 types of strategies that we have right now. I think we've answered most of the questions we've had. I think, is there one other? Joey, did you have anything else you wanted to ask or answer? Sorry.
No, I don't think so. I think we've pretty much covered, if not pretty much everything.
Great. Well, thank you all for participating. If you have questions that do come up after this call, feel free to shoot them to our investor relations group, whose email is ir@Pantera Capital. And we look forward to hopefully partnering with you in the future.